Imagine this scenario. You've invested, maybe poured years into a rental property, managed it, seen it grow in value, and now finally, it's time to sell. You're thinking about that nice capital gain, right? The reward for your efforts. But wait, there's this other thing, a tax concept that often slips under the radar, even for smart investors. It's called depreciation recapture. And it can really change the final number, the actual cash you walk away with. So today, that's our deep dive. Depreciation recapture. It sounds technical, maybe a bit dry, but trust me, understanding this is crucial. We're going to break down what it is, why it exists, and how it works.
That's the plan exactly. We want to, pull back the curtain a bit. We'll cover what depreciation even is, why the IRS wants to recapture it, walk through the math step by step, and really importantly, talk about what you can actually do about it.
Right. So you're not just listening to theory. You'll get a shortcut, basically, to understanding a complex bit of tax law. Practical stuff, strategies you can use. This isn't just numbers. It's about making smarter moves with your investments. Okay, let's start at the beginning then. We know properties can go up in value, the land, the location. But the building itself, it gets older, things wear out. How does the government, account for that for taxes?
Yeah, that's the core idea behind depreciation as a tax deduction. The IRS gets that buildings don't last forever, unlike land. They wear down, need repairs, become obsolete. So they let property owners recover the cost of that building over what they determine is its useful life. It's a way to acknowledge that physical decline. And for residential rentals, they're very specific. You use what's called the straight line method, and the recovery period is 27.5 years. That's the standard.
Straight line, 27.5 years. Got it. And how do you figure out the amount you deduct each year? Is it based on the whole purchase price?
Good question. No, not the whole price. It's based on the depreciable basis. That's generally the purchase price minus the value of the land because land doesn't depreciate, plus any major improvements you've made, like a new roof or kitchen. Then you also subtract any depreciation you've already claimed in prior years. Let's make that concrete. Say you buy a rental for $300,000. Maybe you figure $240,000 is for the building, $60,000 for the land. Your annual depreciation deduction would be roughly $8,727. That's the $240,000 building cost divided by 27.5 years.
Okay, $8,727 a year. And that deduction, it lowers your taxable rental income, right? So you pay less tax each year you own it. Sounds like a pretty good deal.
It definitely is a benefit up front. It reduces your current tax bill, improves cash flow.
I sense a but coming.
Yeah.
The IRS usually doesn't just give things away without some kind of string attached later, does it?
You're right on the money there. It saves you money now, but the IRS has a way to, let's say, balance the scales when you eventually sell the property. And that balancing act, that's precisely what depreciation recapture is all about.
Okay, here's where it gets really interesting for me, and probably for a lot of listeners. If depreciation saves me money, what does recapture actually mean? Are they taking the money back? Why?
Well, recapture means they tax the portion of your gain that relates to those depreciation deductions you took over the years. When you sell, your profit isn't just one big chunk called capital gain, it gets split. Part one is the true capital gain, the property going up in value above what you originally paid for it, adjusted for improvements. Part two is the depreciation recapture. This is the slice of your profit that equals the total depreciation you deducted during your ownership.
So it's not like they're taxing the same income twice. It's more like they gave you a break year after year, recognizing the building was theoretically losing value. But when you sell, and maybe sell for a profit, they say, okay, you didn't actually lose that value in real dollar terms, so we need to tax that benefit you received. Is that kind of the logic?
That's a really good way to put it. It's a rebalancing. You deferred tax liability via depreciation, and now that liability is being realized and taxed upon sale.
Okay, theory is one thing. Let's make this real. How does this calculation actually play out when I sell? Can we walk through an example? Seeing the numbers usually makes it click.
Absolutely. It really comes down to three main steps. Step one, figure out your adjusted basis. You start with what you paid for the building initially, plus any big improvements. Then, and this is key, you subtract all the depreciation you've claimed over the years. So, using our earlier example, building cost $240,000. Let's say over 10 years you claimed $87,270 in depreciation. Your adjusted basis is now $240,000 minus $87,270, which equals $152,730. See how it's lower than your cost?
Right, because the depreciation deductions reduced your basis on paper. Okay, step one, adjusted basis. What's next?
Step two. Determine the amount realized. This is simpler. It's just the sale price minus your selling costs, things like agent commissions, legal fees, closing costs. So if you sell for, say, $400,000 and your costs are $24,000, your amount realized or net sale price is $376,000.
Okay, net sale price $376,000, adjusted basis $152,730.
Now, step three. Step three, calculate the total gain and split it. Your total gain is the net sale price minus the adjusted basis. So $376,000 minus $152,730 gives a total gain of $223,270. Now here's the split. The portion of that gain up to the total depreciation you claimed, $87,270 in our example, is depreciation recapture. Anything above that amount is your long-term capital gain, assuming you held the property more than a year. So $223,270 total gain minus $87,270 recapture leaves $136,000 as capital gain.
That breakdown is crystal clear. So you've got $87K of recapture and $136K of capital gain. And the crucial part is these two pots of money get taxed differently. That's the punchline, right?
Precisely, and this is where the surprise often hits. The depreciation recapture part, that $87,270 is taxed as something called Section 1250 gain. Now, what's really interesting and different from other types of recapture is that for real estate, this Section 1250 gain is taxed at a maximum rate of 25%.
25% max. How does that compare to the capital gains rate?
Well, that's the kicker. Your long-term capital gains, the $136,000 in our example, might be taxed at 0%, 15%, or 20%, depending on your overall income level, often lower rates. But the recaptured depreciation, that can be taxed at that higher 25% rate, even if your regular income tax bracket is lower than 25%. It's a special, often higher rate, specifically for that recaptured amount.
Wow. Okay, so you absolutely cannot assume your entire profit gets the favorable long-term capital gains treatment. A chunk of it, potentially a big chunk, gets hit with this potentially higher 25% rate. That could make a serious dent in your net proceeds.
It really can. It's probably one of the biggest misunderstandings in real estate taxation.
Now, you mentioned earlier there are some finer points, maybe some IRS rules or pitfalls we need to know about beyond just the calculation. What are those?
Yes, there are definitely some nuances, and one is absolutely critical. The concept of allowed or allowable depreciation. This trips up a lot of people. The IRS calculates recapture based on the depreciation you could have taken, the amount that was allowable under the rules, even if you never actually claimed it on your tax returns.
Wait, really? So even if I just didn't bother claiming depreciation some years, or maybe I didn't know I could, the IRS still treats it as if I did when it comes to recapture.
That's exactly right. They basically say the deduction was available to you, you are allowed to take it. Failing to claim it doesn't get you out of the recapture calculation later. The basis is still reduced by the allowable amount.
Ouch. That seems tough. What's the logic there?
The logic, from the IRS perspective, is consistency and preventing manipulation. They don't want taxpayers choosing not to take depreciation in early years just to avoid recapture later. The wear and tear happened, the deduction was allowable, so it counts towards basis reduction and potential recapture. It underscores the need for good record keeping and tax advice from the start. Another point. Improvements. When you make significant capital improvements, a new HVAC system, remodeling a bathroom, those costs are added to your basis and depreciated separately. And yes, that depreciation is also subject to recapture when you sell.
Okay, so improvements get folded in too. What about ways to potentially manage this tax hit?
Well, the big one is the Section 131 like-kind exchange. This is a really powerful strategy. If you sell an investment property and reinvest the proceeds into another similar investment property following very specific rules and timelines, you can defer both the capital gains tax and the depreciation recapture tax. It basically rolls over into the new property.
That sounds like a huge advantage for serious investors. Keep the money working without an immediate tax hit.
It is. Another thing to be aware of is primary residence conversion. If you rent out a house, take depreciation, and then later move into it yourself, when you eventually sell that home, even if you qualify for the home sale exclusion, the Section 121 on some of the gain, you still have to recapture the depreciation you took during the rental period. That part isn't excluded.
Okay, so the rental history follows the property, tax-wise.
Correct. And finally, don't forget state taxes. We've been talking federal, but your state likely has its own rules on capital gains and depreciation recapture, adding another layer to the calculation.
Good reminder, federal isn't the end of the story. That allowed or allowable rule really sticks with me, though. It means you need to be tracking this stuff properly all along. Okay, let's cement this. Can we run through that full example again, but this time calculate the actual tax hit? Seeing the dollars and cents makes it really concrete.
Definitely. Let's use slightly different numbers for a full picture. Say the building cost was $240,000. You owned it for 15 years and claimed $130,900 in depreciation. Your adjusted basis is now $240,000 minus $130,900, which equals $109,100. Now you sell, and after costs, your net sale price is $400,000. Your total gain is $400,000 minus $109,100. It is $290,900.
Okay, total gain $290,900.
The depreciation recapture portion is the total depreciation claimed, $130,900. This part is taxed at up to 25%. The remaining gain is the capital gain. $290,900 total gain minus $130,900 recapture equals $160,000. This is taxed at the long-term capital gains rate, 0%, 15%, or 20%.
Got it. $130,900 recapture, $160,000 in capital gain. Now the tax, let's say the seller's in the 24% regular income bracket.
Okay, so the tax calculation would look something like this. The recapture tax. 25% of $130,900 equals $32,725. The capital gains tax. Assuming they fall into the 15% capital gains bracket, that's 15% of $160,000, which is $24,000. Add those together, the total federal tax liability from this sale is $56,725.
Wow, over $56,000 just in federal tax. That's a serious chunk of the profit. It really drives home why understanding recapture before you sell is so important.
Absolutely. It's not pocket change. It's a significant factor in your net return.
So facing that kind of tax bill, what strategies can owners actually use? You mentioned the 1031 exchange, which defers everything. Are there other options, maybe if a 1031 doesn't work for someone?
Yes, there are other considerations, though maybe not as comprehensive as the 1031. We talked about the 1031 exchange. That's the gold standard for deferral if you plan to reinvest. Another possibility is an installment sale. This is where you, the seller, essentially finance the buyer and they pay you over several years. This lets you spread the recognition of the capital gain portion over those years.
Okay, so that could lower the tax hit in any single year for the capital gain part.
Exactly. But, and this is a huge but, the IRS requires you to recognize all of the depreciation recapture in the very first year of the installment sale, regardless of how much cash you actually received that year.
Ooh, okay. So installment sales help with the capital gain timing, but not the recapture timing. That's a critical distinction.
Very critical. It limits the benefit significantly if there's a lot of recapture involved. You could also think about timing of the sale. While it won't change the 25% max rate on recapture, selling in a year where your overall income is lower might drop you into a lower tax bracket for the capital gains portion, maybe 0% or 15% instead of 20%. It requires careful planning around your other income sources.
Makes sense. Optimize what you can control.
And then there's estate planning. This isn't really a strategy for the owner, but for their heirs. If you hold the property until you pass away, your heirs generally receive what's called a step-up in basis. The property's basis is adjusted to its fair market value at the date of death. This step-up completely eliminates the capital gain that accrued during your lifetime, and it wipes out the potential depreciation recapture liability.
So inheriting property basically resets the clock for tax purposes. That's huge for passing on wealth.
It's a very significant benefit in the tax code, yes.
Looking at these strategies, the 1031, the installment sale nuance, timing, the step-up basis, it really highlights that these aren't just random tax rules. They're levers you can potentially pull, tools for planning if you know they exist and how they work.
That's the perfect way to frame it. Knowledge of these rules allows for strategic decision-making rather than just reacting to a tax bill after the fact.
So let's wrap this up. The big takeaway seems clear. Depreciation is great while you own the property, saves you tax dollars year after year. But it's temporary. That benefit will be accounted for or recaptured when you sell. And that recaptured portion is often taxed at a specific, potentially higher rate, up to 25%. It's not just regular capital gain.
Precisely. Understanding your adjusted basis, calculating the gain correctly, and knowing how it splits between recapture and capital gain, that's non-negotiable for investors. And it really makes you think, doesn't it? How does knowing this impact how you view the long-term hold of a property?
It absolutely should. Planning becomes paramount. Knowing about things like the 1031 exchange, or even just anticipating the recapture tax hit in your sale projections, can make a massive difference to your actual bottom line. Preparation is key.
And echoing what I said earlier, but it bears repeating, anyone selling a rental property or even thinking about it really needs to sit down with a qualified tax professional. These rules have nuances, and getting personalized advice is crucial to navigating them correctly and optimizing your outcome.
Couldn't agree more. Professional advice is invaluable here. So as we leave you today, here's a final thought to ponder. Knowing what you now know, especially about that allowed or allowable depreciation rule, How might you reconsider your approach not just to real estate, but to any asset you own that depreciates for tax purposes? Think about business equipment, vehicles. This concept has broader reach. How does it fit into your overall financial picture?